Whenever you research potential investments, you have to be careful that you don't make a mistake. One false move can be disastrous for our long-term financial planning. In his 2013 letter to Berkshire Hathaway shareholders, Warren Buffett wrote that he'd left specific instructions for the trustee of his estate that after he passed, 90% of his estate should be put in a very low-cost S&P 500 index fund, and that he suggests Vanguards. So what's so special about it? In today's video, we're going to cover everything VOO, including what an index fund is, returns to expect, dividends, expenses, volatility, what kind of companies are in it, and so much more coming up next. So what is VOO? Well, it's Vanguard's S&P 500 ETF index fund. The V is Roman numeral 5, followed by OO to represent 500 of the biggest American companies. It's almost identical to Vanguard's VFIAX mutual fund. Almost all of the info I discuss here will also apply to VFIAX, with some exceptions mostly related to the difference between an ETF and a mutual fund. Just how big is VOO? Well, in the first quarter of 2023, it had total assets of over $750 billion. That's comparable to the GDP of the state of Georgia. In terms of countries by GDP, it would be number 19 on the list between the Netherlands and Saudi Arabia. It comprises about 9.5% of Vanguard's total book of assets under management, which is a little over $8 trillion. It's huge. Clearly, investors have spoken here, so why is it so popular? We'll dig into that next, but real quick, you deserve the best content possible. If you feel I've earned it, hit that like button to give me some of that immediate feedback. It also lets YouTube know to share it with more people. To set the stage, let's answer the following question. What is an index fund and what is an ETF? To answer that, let's dig into a bit of history real quick. First, what is an index fund? Who came up with it and why does it even matter? It all starts with Jack Bogle, the author of the Little Book of Common Sense Investing and founder of Vanguard. When he founded Vanguard in 1975, it was in an era when the cost to invest could range from 1% to 3%. Mr. Bogle felt that the industry could do better and wanted to focus on the average everyday investor. He transformed the mutual fund world by creating index investing, which allows investors to buy mutual funds that track the broader market. The takeaway here is that an index fund is designed for the average investor. Once ETFs came into the picture, the way was paved for VOO to enter the scene. Okay, so the next question is, how does an index fund work? To start, you cannot invest in an index. An index is simply a benchmark used to represent a larger group of stocks. A financial institution such as Vanguard will pay for a license, kind of like you have to pay for a license to use Microsoft's various products. They will buy this license from a research and analytics company such as the University of Chicago's CRISP, Standard & Poor, Morgan Stanley, Russell, or the Dow Jones. While Vanguard currently uses or has used all of these vendors for their different index funds, there's only one Standard & Poor's 500 index. Vanguard or any other index fund provider's goal is to create a fund that perfectly matches that benchmark. This then results in a higher level of confidence that the investor is getting the investment that they thought they were getting. It's very affordable, has low turnover, and is a passively managed investment. Here you can see that VOO has a 1.0 relationship to the S&P 500 index. This means that it has perfectly matched the S&P over the past 3 years. This isn't good or bad from a market performance perspective, but it does mean that they've matched the index. If you own VOO, you're getting exactly what was advertised. Alright, so what is an indexed ETF? It's simply an exchange-traded fund that is tracking a specific index. In this case, the S&P 500 is what it's tracking. It's similar to an index mutual fund in that it holds a collection of stocks in a single fund that is passively managed. Passively managed just means that they're not churning through stocks trying to create the perfect portfolio and also generating commissions as a result. It's also similar to an individual stock in that it can be traded throughout the day on the stock exchanges even as the prices fluctuate throughout a trading session. This differs from a mutual fund which executes on any trades after the market closes. You can get a little into the weeds here on the pros and cons of an ETF versus a mutual fund. The only hiccup that can really occur here as it relates to vendors is that some allow for fractional purchases of a mutual fund versus not allowing it for an ETF. Being an ETF, your vendor may require you to buy a complete share of VOO, or if they do allow fractional shares, it will often need to be during trading hours. A huge benefit to buying an index fund is that the cost to invest, which is the expense ratio, is usually very low. VOO has one of the lowest expense ratios in the industry at just 3 basis points. 100 basis points is 1%. To put that in perspective, the average expense ratio in the 90s was about 73 basis points. Now it's dirt cheap, whether you buy an S&P 500 index fund through Fidelity, Spider, or any other vendor. $10,000 invested at an expense ratio of just 3 basis points means it costs you $3 to invest. The only additional expense that you pay is through something called the bid-ask spread. This is a slight margin built into the price of the purchase to compensate the vendor completing the trade. In this case, they're asking for a spread of another 9 cents beyond the bid price to facilitate the transaction. Because we're not day trading, it's a minuscule amount. So what are you getting when you buy VOO? What's in the fund? To start, to be a part of the index, a committee must select a company, and that company must be a representative of the industries that make up the US economy. They must currently have 14.6 billion in market capitalization or greater. As companies rise and fall, the index will change in order to stay current. It's a domestic fund, which means it's a US blend of large cap with a weighting for everything. This excludes any mid-cap and small cap companies. It's got everything from consumer discretionary to financials, healthcare, industrials, internet technology, and more. Right now, the highest valued holding in VOO is Apple at about 51 billion, which makes up over 6% of the fund. The top 10 holdings of VOO make up about 25% of the total fund. If we go towards the bottom to the smallest large cap holding, we can see that 0.01% of the fund still comes out to over $100 million in market value. This shows us how broad our exposure is to different stocks just by purchasing a single index fund like VOO. As far as rate of return is concerned, if we look at this chart of the S&P 500, some of the highest returns are after the market has tanked. In fact, since 1928, I count 26 times that the S&P has cracked 20% returns, 9 times that it's exceeded 30%, and 3 times that it's cracked a whopping 40% in returns. Almost every time it's after a market downturn. Since its inception in September 2010, VOO averaged just over 13% in annual returns. Only 10 years of data though. To give us some more perspective on how it performs in hard times, let's go back 15 years. Although VOO has not yet been created, the S&P 500 index was alive and kicking. When the market tanked, it dropped about 38.5%. We had a bull market for a number of years, but 2022 was not a good year for the market, and similar to 2008, the S&P dropped about 20%. VOO does pay a dividend on a quarterly basis. In 2022, it came out to about $6 per share, or a dividend of about 1.6%. Dividends in a fund like this aren't going to sustain your retirement, but they are a great way to boost your capital appreciation by reinvesting them. Alright, so do I recommend VOO? Well, YouTube is full of people giving stock picks. I'm not a financial or fiduciary advisor in any capacity. It would be inappropriate for me to make a recommendation to you directly, even if I knew your situation. If you want financial advice tailored to you, I would recommend a fee-only advisor that is a fiduciary. A fiduciary is simply someone who is legally and ethically obligated to put your interests ahead of their own. With that being said, I can give you some broad statements about the fund, and you can make the decision for yourself. Over the past 20 years, 95% of large cap funds did worse than the S&P 500. In 18 of the past 21 years, 50% of active managers who are financial professionals whose entire job is to deliver high returns lost to the S&P 500 and VOO. I'm not sure that you can beat those odds. If you have a long-term investment horizon, are seeking an aggressive investment vehicle, and are willing to ride out a repeat of 2008 or 2022, it might be the fund for you. Lastly, buying VOO gives you 50% of the global equity market cap. Alrighty folks, that wraps it up for today. Let me know in the comments if you own this ETF or if you tend to start investing in it. Until next time.